Do you think you don't need to file Form 709 because you didn't owe any gift tax? That assumption has cost people years of statute of limitations exposure, and in some cases, handed the IRS a roadmap to challenge transfers you thought were settled years ago. Here's what most people get wrong about the gift tax return, and why not filing can be far more dangerous than filing. I'm attorney Chad Silver, founder of Silver Tax Group. We handle IRS defense and offshore compliance. It's all we've done for 20 years. If you've made gifts over the annual exclusion and never filed a 709, or you filed one and you're not sure it was done right, call us at 855-900-1040 or visit silvertaxgroup.com for a confidential review. Section 1, when Form 709 is required, let's start with the basics, because this is where most people get tripped up. In 2026, if you give more than $19,000 to any one person in a calendar year, whether that's cash, real estate, crypto, stock, you generally must file Form 709. That's $19,000 per recipient, per donor. Married couples who split gifts can give up to $38,000 per person without triggering the filing requirement. But here's the part nobody talks about. The filing obligation is completely separate from the tax obligation. The lifetime exemption in 2026 is $15 million. Most taxpayers will never owe $1 of gift tax in their lifetime. But if you jump the annual exclusion, you file, period. No exceptions. Also, gifts of a future interest must be reported regardless of dollar amount. Zero annual exclusion applies. If you put assets in an irrevocable trust for your children, you file Form 709. End of story. And one more thing. There's now a question on page 1 of Form 709 that asks directly whether any gift you're reporting involves digital assets, crypto, tokens, NFTs. The IRS makes it crystal clear in the instructions. You cannot leave that question blank. Section 2, the statute of limitations trap. Now let's talk about the penalty most people assume doesn't apply to them. If you fail to file Form 709 and gift tax is actually due, the penalty is 5% per month of the unpaid tax, capped at 25%. If no tax is due, there's generally no monetary penalty for late filing, and that technicality creates a false sense of security. Here's why. When you file Form 709 and adequately disclose the gift, including its fair market value, the recipient, and the nature of the transfer, you start the statute of limitations clock. The IRS generally has 3 years from the filing date to challenge the valuation or to challenge the characterization of that gift. If you never file, the clock never starts. Adequate disclosure is the key phrase here. A vague description, no valuation support. Missing schedules. The IRS can reject that as inadequate, and the clock still doesn't start. The return has to be done right. The bottom line, filing the 709 protects you. Not filing leaves the door open indefinitely. The IRS can come back 5 years, 10 years, 15 years later and question whether that $150,000 transferred to your son was really a gift or whether it should be recharacterized as something else entirely. If any of this sounds familiar, if you've made gifts and never filed, call us at 855-900-1040 or visit silvertaxgroup.com. We'll tell you exactly where you stand. Section 3, case scenario of Michael. Let me give you a real scenario. Michael is a U.S. citizen living in California. In 2023, he gave his daughter $100,000 toward a down payment on her first home. In 2024, he gave her another $85,000 for renovations. The annual exclusion was $17,000 in 2023 and $18,000 in 2024. So each year, Michael exceeded the exclusion by a significant margin. $83,000 the first year, $67,000 the second. He never filed Form 709 for either year. Michael's logic was simple. I'm not anywhere near the $13 million lifetime limit. There's no tax due, so why file? He's not wrong about the tax. He didn't owe gift tax on those amounts. But here's what he didn't consider. The IRS receives currency transaction reports from banks. Large wire transfers and structured deposits get flagged. If the IRS reviews Michael's returns and sees a pattern of six-figure transfers to a family member with no corresponding gift tax return on file, they can open an examination. Not necessarily to collect gift tax, but to investigate whether those transfers were properly characterized. Were they gifts? Were they disguised compensation? Were they an advance on inheritance subject to different rules? Now Michael's looking at 3 years of unfiled 709, an open statute of limitations with no end date, and an IRS inquiry he could have avoided entirely with a one-page form. Section 4. How to fix it. So what do you do if you're in Michael's position? First, don't panic, but don't wait. The longer these go uncorrected, the more exposure you have. The IRS can and does review gift tax compliance, especially for high net worth taxpayers and anyone with foreign account reporting obligations, because FBAR and Form 709 issues often travel together. Second, you can file late 709s. There's no amnesty program specific to gift tax, but filing before the IRS contacts you is always better than filing after. Adequate disclosure on a late filed return can still start the statute of limitations from the date of filing. Third, make absolutely sure the return is done right. A poorly disclosed gift is almost as bad as no return at all. Missing schedules, vague descriptions, no valuation support, the IRS can reject it and the clock still doesn't start. We build your compliance strategy, we implement it, and we'll defend it if necessary. Whether you missed a single year of 709 filings or you've never filed one and have made substantial gifts over multiple years, we can help you get it cleaned up before the IRS comes asking questions. Call 855-900-1040 or visit silvertaxgroup.com for a confidential review. Don't wait until the IRS comes knocking at your door. I'm tax attorney Chad Silver. Click like if you found this useful and subscribe for more. Thanks for watching.